We are being joined now by Jeff Chowdhry of LGM Investments, a long-time watcher, I think a three-decade watcher of the Indian skies. Well, Jeff, good morning and always good to have you with us. There's been a strong rally in EMs and India has participated, even if it has not risen as much as the Brazils of the world. But at these levels, do valuations worry you?
No, they don't. For a couple of reasons. I think you're right. Obviously, emerging markets have had quite a good year, up nearly 20% in US dollar terms. I see that as basically as investors taking some money out of the more expensive markets of the US and being a little bit more concerned about political risk, both in the US and in Europe, and going into an asset class which is deeply underowned and very good value. And I think India, even though it's expensive within emerging markets, is still good value relative to a lot of other developed markets.
Jeff, TCS is the other one that we were discussing. That's issued a near profit warning. Would you sell out of your IT investments now or just keep buying at lower levels?
Okay, well, we don't have any, first of all, I just sort of declare that we don't have any exposure to the IT sector at this point in time. We did sell out about a year ago. And our view really on the IT sector is twofold. I think, first of all, generally the blue chips like TCS and Infosys, etc., are very well managed companies, and we have a lot of high regard for the management teams. The reason why we sold out, we were slightly concerned about the weak growth both in Europe and in terms of the US. One, and secondly, we were concerned about increasing competition, particularly for the large companies who are really competing against the other big companies like Accenture and IBM. So when these companies were $5 billion companies, it was much easier for them to get market share. Now that they're at $40 or $50 billion companies, it makes it much more difficult. So that was the reason why we sold out. I think sort of looking forward from here, I think it's going to be quite a tricky environment, particularly on the competition front for many of these companies, certainly the bigger companies. And I think the other thing which has obviously happened over the last 5 years is obviously valuations of the sector have gone up quite a lot. So at this point in time, we remain cautious about the sector, and we're not planning to add to our positions or start positions at this point in time.
Okay, that's unambiguous. Jeff, let me come to the telecom sector. After the REL Geo launch, would you worry about this sector or are you a buyer at lower levels?
So simple answer is no, because we don't have anything in the telecom sector. So we're not really worrying about it. You know this very well, and we all know this very well, is that the Indian mobile phone sector is probably the most competitive in the world. It's certainly got the lowest calling rates. When I come to India regularly, I'm always surprised that after a week of calling, my entire bill is about 5 rupees. So it's a sector which obviously has huge amount of competition. In my opinion, still too many players. Whether Reliance will be successful with this, I don't know simply. But at the moment, we're not joining in terms of the party as far as investing concerned.
Okay, maybe you meant $5. What about the banks? Have you started buying the PSU banks?
Okay, so I think there's two parts to the question here. Let me answer the first part is we're absolutely not surprised that the banking sector has done well. It's been one of our biggest overweights for many, many years. We have focused our attention on the private sector banks. HDFC Bank and Yes Bank are our biggest holdings, continue to be our biggest holdings. And historically, we've shunned the public sector banks for all the reasons that you know, but primarily because the quality of the management, I would say, are not up there with the private sector banks. Now, obviously, the sector's done very well. People have been looking around for other, laggards. Obviously, the public sector banks relative to the private sector banks are obviously very cheap. But in our opinion, we want to stick with quality, and that means private sector banks, even though they may be more expensive than the public sector banks at this point in time. So no real changes to our portfolios. We like very much the banking sector. That really is a sort of a warrant of play, whatever you want to call it, on the Indian economy. And we're sticking with our positions in the private sector banks.
Okay, what about non-banks? Non-bank finance companies are the ones that have been the leaders of this rally.
Yeah, I mean, selectively. I mean, things like Mahindra Financial Services is in good shape. A number of others as well. That's a reasonable. But I think with the non-banking financial sector, you've got to be very careful, because they do tend to be in very niche areas of very niche markets, and you've just got to make sure that you're in companies which have a niche which is growing and where there's not competition. The reason why we prefer the private sector banks like HDFC Bank or Yes Bank is because of their footprint, obviously both in terms of across India and also across sectors and in terms of different areas of the market. So that's really it. But yeah, I mean, selectively we do have some non-bank financial services companies.
Okay, last question from my end then. What else do you like in Indian space?
I think just following on with the theme that I've just touched upon, I mean, I wouldn't say everything, because that's a sort of a sweeping generalization, but large parts of the consumer sector. So, companies like ITC, companies like Hindustan Lever, companies Nestle, companies which are basically in the consumer space. For us, forget the next sort of 1 to 2 years. Again, I've been involved in India for the last 20 years. And again, if I was making a 20-year prediction, I would be saying to, people, investors, really stick with those consumer companies, and consumer companies where the products are not going to fall out of fashion. Everyone needs to drink, everyone needs to wash themselves, and increasingly so, everyone needs to use other household products, etc. These are the types of companies where, frankly, they'll either be much, much bigger than they are in 20 years' time, or they will have merged and become even bigger.
Jeff, it's always a pleasure speaking with you. Thank you for that fund of stock discussions that we had. We'll, of course, meet again. Thank you very much for joining us.